today's class, and today I would want us to look at portfolio management under CIFA. Basically, I would want us to look at the second topic called risk and returns. Risk and returns. Ladies and gentlemen, under risk and returns, what are we supposed to know? Under risk and returns, number one, you must know the definition of the word a portfolio, where we say that a portfolio is a combination of assets, where basically a single investor goes for many assets and bundles them up, puts them in one basket. Now, ladies and gentlemen, if, for example, today you were to get, say, 20 million Kenya shillings, how will you invest this money? Most of us, because of being misguided, will basically rush with this money, the whole of it, to real estate. And once you put this money, all of it, to the real estate, you put up a big apartment, and then automatically you'll get like the county government telling you that this great apartment of yours, you have built it on a riparian land that doesn't belong to you. And then automatically you'll see those people coming with those tractors, wanting to do what? To demolish everything. Now, trust you me, when you see your 20 million, all of it once going to the drains, chances are you will become mad. You'll become crazy. And the biggest mistake that you did was to go against our old adage that you're never supposed to put all your eggs in one basket. These are your eggs. How do you put it in just one venture? No. You're supposed to split these. Have some of this money here buying shares, some of this money buying land, some other money, in this case, even buying a finished apartment. Some money, ladies and gentlemen, if possible, you can even have a bus, a matatu, etc. So, ladies and gentlemen, the concept is that we are spreading it out. And we are spreading it out basically to minimize what here? Risk, what we call business risk. So when we make reference to business risk, you're supposed to remember that business risk basically refers to fluctuations of a company's earnings out of its investments. You will get, for example, your investments this year giving you like 10 million Kenya shillings. Next year, they give you 20 million Kenya shillings. Another year, for example, you even make losses. So in this case here, that one makes the risk of the project to be very high. Whenever you have returns arising out of an investment fluctuating often, then that will be regarded to us a very risky venture. Back home here, that is where they normally tell us that matatu business is very risky. Why? Because at times you get a lot of money. You even wonder how come these people have been able to give me this money. At times in this case here, you get nothing. At times you even make losses because you'll be called upon to go and pick your matatu perhaps in a police station where you'll be required in this case here to make some payments over there, ladies and gentlemen. So quite risky. But when you go to, for example, investing in a government bond, in government bonds, what do you know about government bonds? Ladies and gentlemen, government bonds will always attract what we call fixed coupon interest rates. So the rate of return is fixed. So year one, you're getting 10 million. Year two, you're getting 10 million, perhaps year three, 10 million, etc. However, with the fixed returns, meaning that we don't have any risk, returns are fixed, we don't have any risk, you'll automatically realize that the risk-free rate of return is low. The risk-free rate of return is what here? Is low. The risk-free rate of return is low. So generally, the higher the risk, the higher the returns. The higher the risk, the higher the returns. General principle of finance. The higher the risk, the higher the returns. Most importantly for this lesson, you're supposed to know that business risk has two components. Business risk has got two components, full colon. We have what we call the systematic risk. And then number two, we have the unsystematic risk. Unsystematic risk. So we have the systematic risk and what here? Unsystematic risk. So great students of mine, listen to me very well. Whenever you have your examiner asking you to differentiate between the two, between the two types of risks, listen here. You're supposed to draw a diagram. Draw a diagram like this. Draw a diagram like that. And the moment you draw a diagram, ladies and gentlemen, like this, the moment you draw a diagram like this, down here, we'll be talking of the systematic risk, the one that is uniformly distributed in the industry, uniformly distributed in the industry. And then here, we'll be talking of what we call unsystematic risk, the one that reduces as our portfolio. This is portfolio size, capturing the number of investments, portfolio size capturing the number of investments. So of course, we have this being the business risk. This is the business risk. So as business, or rather as the portfolio size grows, we'll have risk reducing. The risk that reduces as we spread out our investments, ladies and gentlemen, is what we call unsystematic risk. So unsystematic risk is that risk which is company specific. It affects specific companies. It affects specific companies. And because of it affecting specific companies, as an investor, I can avoid those companies which are affected by unsystematic risk. And if I avoid them, then I will be reducing my overall business risk. I'll be reducing the unsystematic. What unsystematic means non-uniform, not uniform, ladies and gentlemen. And then we have what we are calling systematic risk from the name systematic, uniformly distributed. These are those risks that exist, ladies and gentlemen, all over. Those risks that exist all over, throughout the entire economy, throughout the entire economy. There is no way you will ever run away from systematic risks. And that is why you can see that systematic risks here are unreducible. You can't reduce them. They are undiversifiable. You can't diversify them because they cut across all sectors of the economy, all businesses of the economy. Now, ladies and gentlemen, for us here, what are we supposed to remember? For us here, what are we supposed to remember? What are we supposed to know? Just for purpose of understanding this, I would want us to just mention some example here. We have returns of security X. We have returns of security Y. Then they have given us probabilities for our two states of nature. So the probability here could be 0.4. Here we have 0.6. Ladies and gentlemen, the return here could be like 15, 18. The return here could be like 12. And then we have what here? 20, like that. So we are required to do a few things here. We are required, number one, to ascertain the expected returns of the securities. Right there, expected returns of the securities. So we have here expected, ascertain the expected returns of securities. Expected returns of what here? Securities. Expected returns of securities. So how do we get solution? How do we get expected returns of X? So to get expected returns of X, ladies and gentlemen, what you need to do is to take the actual returns given times their corresponding probabilities. So take the actual returns given here times their corresponding probabilities. You take, because we are not so sure whether it is 15, we shall realize, or 18, we're not so sure. So what we shall do is to incorporate the probabilities there. So ladies and gentlemen, my expected returns of X here will be 15 times 0.4 plus 18 times 0.6, which at the end of the day will give us what figures? Which at the end of the day will give us what figures? Ladies and gentlemen, with my great calculator here, I'll be able to pick this figure very first, which I'm so sure most of us already have gotten. So we have here 15 times 0.4. 15 times 0.4 plus 18 times 0.6. 18 times 0.6, which gives me 16 point what here? 16.8. 16.8. 16 point what here? 0.8. 16.8. So on the same breath, could you kindly give me the expected returns of Y? What we need to do is to take the actual returns of Y times the corresponding probabilities. So we have 12 times 0.4 plus 20 times 0.6, like that. So with that, now I should be able to get the expected returns of Y. expected returns of y, I should be able to get the expected returns of y, which will be 12 times 0.4 plus 12 times 0.4 plus 20 times 0.6. 20 times 0.6, which gives me 16.8 as well. 16.8 as well. You just have to be careful. 12 times 0.4 plus 20 times 0.6. So 16.8. Let me just confirm the earlier one. That coincidence is good, but at times a bit scaring. So we have 15 times 0.4. 15 times 0.4 plus 18 times 0.6, which at the end of the day will give us 16.8. Great. So having gotten these expected returns, the next thing that I would want you to do is to give us the standard deviations of the securities. So come and give us the standard deviations of the securities. Give us the standard deviations of the securities. So number 2, I want you to ascertain the standard deviations of the securities. So standard deviation of X. Standard deviation of X, ladies and gentlemen, is quite an easy thing. Deviation means subtraction. We are subtracting 2 returns, actual returns vis-a-vis our average returns. So we have here our standard deviation of X will be equal to actual returns of X minus expected returns of X, like that. So Rx minus ERX. Ladies and gentlemen, with this, now what I need to do is to come and square them. Because remember, by just definition, standard deviation has got a squared because it's root mean square. So the deviations, this is a special thing. The deviations must be squared. And of course, after you do that, you must come and incorporate the probabilities, the risk factors. Now, these deviations are many, so you have to sum them. And of course, it cannot be called a standard deviation if it doesn't have what? A square root. If it doesn't have a square root. Now, with this in mind, I would want us to calculate the standard deviation of X first. So then what do we have here? I will come and pick the actual returns of X, 15 and 18. Minus expected returns that we got. Expected returns of X, we have 16.8, 16.8. Ladies and gentlemen, from there, what I'll do, I'll come and square times the probability. The probabilities, I already have them here. We have 0.4, we have 0.6. So please come and give us figures. Give us figures. Give us figures here. Give us figures here. Give us figures. Please don't get square root first. Square root will come after you have summed, after summation. So what do we have here? I have my brackets, 15 minus 16.8 minus 16.8, close, close. And then we have squared times 0.4. What figure are we able to get? 1.296. So I have here 1.296. 1.296. Go to the second one. The second one, ladies and gentlemen, what do we have here? I can see 18. So we have 18 minus 16.8 minus 16.8 equals, and then we square these, times 0.6, which, ladies and gentlemen, will give us 0.864. So we have here 0.864. 0.864. Now please come and add the 2. So you add the 2, so plus, add the 2. So we have here plus 1.29, 1.296, give us a figure which gives us 2.16. This 2.16 is your total variance. Is your total variance. And remember, for you to get the standard deviation with symbols like this, you need to come and give us the square root of this. So please give us the square root of 2.16. So we have here square root of 2.16. So square root of 2.16, I can see 1.47. 1.47. So this will be equal to the square root of 2 point. Let me check again. This is supposed to be 2.16. Square root of 2.16. So square root of 2.16, yeah, it's 1.47. So we have here 2.16 square root is 1.47 like that. 1.47. I'll have to save this thing somewhere. Standard deviation of x is 1.47. Now, using the same style, ladies and gentlemen, I would expect you guys to go ahead and give us the standard deviation of y. Go ahead and give us the standard deviation of y. Give us the standard deviation of y. So how will I get the standard deviation of y? Our formula is pretty easy. Our formula for getting standard deviation of y, we are looking at the difference between two types of returns. The actual return of y vis-a-vis the expected return of y. And these must be squared times probability. And because there are many deviations, you must sum them. And then at the end of the day, crown it up by having a square root. Crown it up by having a square root. Ladies and gentlemen, if that is the case, then we have our actual returns of y there here. We have 12, we have 20, minus. Expected returns of y, if you recall. From part 1 above, the expected return was 16.8. So 16.8, like this, come and the square times the corresponding probability. Corresponding probability, what do we have? We have 0.4, we have 0.6. So please come and give us figures. Give us figures. What do we have there? Give us figures. Give us figures. What do we have there? So give us figures, ladies and gentlemen. We have open brackets. We have 12 minus 16.8. You close brackets, you say squared, times 0.4. If you say times 0.4, I'm able to see 9.216. I'm able to see here 9.216. And then, ladies and gentlemen, I have the next one, which is 20 minus 16.8 equals squared times 0.6. At the end of the day, we'll get here 6.144. So please come and add everything there, plus 9.216 equals, I'm able to see 15.36, ladies and gentlemen. That is our total variance. This is our total variance. And once you have the total variance, now what you need to do is to give us the square root of that to ascertain the standard deviation. So come and give us the square root of this. So square root of 15.36. What figure are we able to see here, ladies and gentlemen? So this will be the square root of 15.36, which gives us a standard deviation of y of 3.92. So standard deviation of y is 3.92. Standard deviation of y is 3.92. 3.92. Now, ladies and gentlemen, the moment I have those two standard deviations, I would want us to go to the next concept. I would want us to go to the next concept now here. This next concept is an easy one. This next concept is an easy one. I would want you great students of ours to look at this third scenario where we have J. Aura has bought 30% of security X and 70% of Y. 30% of security X and 70% of Y. So in short, J. Aura has formed a portfolio. Has formed a portfolio because a portfolio is a combination of investments. So you are required here, number one, ladies and gentlemen, or A, to ascertain the expected returns of the portfolio. The expected returns of the portfolio. Expected returns of the portfolio with those weights. And then B, ladies and gentlemen, they want us again to ascertain the standard deviation of what here? The portfolio. You ascertain the standard deviation of the portfolio. The standard deviation of the portfolio. Let us first of all handle these. Ladies and gentlemen, for us to handle these, we need to come here and write for them the formula of getting expected return of a portfolio. To get expected return of our portfolio here, I have to use what we call the weighted average concept. The weighted average concept. So under weighted average concept, you will take the weight of X, expected return of X, plus weight of Y, expected return of Y. Weight of X, expected return of X, because you know I consumed something small from X. As well, I consume something small from Y. So this W stands for the weights. W are the investment proportions. So we have here weight of X will be 0.3 because I bought 30% of X. So weight of X will be 0.3, and then we have weight of Y being 0. What? Somebody there, 7. Ladies and gentlemen, if that is the case, you should be able to give me the expected return of the portfolio through some proper substitution. So come and substitute here. So we have weight of X is 0.3. Don't forget that the expected return of X, which was equal to expected return of Y, was 16.8. So times 16.8% plus 0.7 times 16.8%, you can decide to disregard the percentages. You can disregard them. So when you multiply like that at the end of the day, ladies and gentlemen, you will end up getting 16.8 what year percent as the expected return of the portfolio. It will be the same. I expect that because the two securities are promising the same level of returns. If you try using your calculator, you will end up getting that. And then now we can embark on part 2 of this question. Part 2 of this question wants us to give them the standard deviation of the portfolio. Standard deviation of the portfolio. Ladies and gentlemen, I can't get standard deviation of the portfolio without getting the covariance. So first of all, give me the covariance of the portfolio. The covariance between the securities of the portfolio. So give me the covariance of X and Y. Give me the covariance of X and Y. So covariance of X and Y, what do I have? First of all, the meaning of the word covariance. Covariance is a shared variance. Covariance is the shared variance. Covariance is the shared variance. Ladies and gentlemen, this covariance between the two securities here, how will I be able to get the covariance between these two securities? It's quite easy. What I need to do is to work with the deviation of X, multiply by the deviation of Y times the probability. Deviation of X multiplied by deviation of Y times the probability. So please write this in full. This is deviation of X multiplied by deviation of Y times probability. Ladies and gentlemen, what is our deviation of X? How do we get this deviation of X? It's very easy. You'll take the actual returns of X minus the expected returns of X, because it's deviation of the actual returns from the expected returns. So returns of X minus expected returns of X into the deviations of Y. So deviations of Y, what do we have here? We have RY minus expected returns of Y times the probabilities, like that. Ladies and gentlemen, at the end of the day, of course, you must sum them. You must sum this. So come right away here and pick the actual returns. The actual returns of X, I have them here. We have 1518 minus expected returns. We have obtained them up there. Expected return here was 16.8, 16.8, 16.8, 16.8. Remember, expected return doesn't keep on fluctuating. So come and pick the actual returns of Y. The actual returns of Y, we have 12, we have 20, minus. Expected returns of Y. Expected returns of Y, we found that in part 1 of this question. The expected return of Y was 16.8 as well. 16.8 like that. Times the probabilities. Times the probabilities that we have here, which are 0.4 and what here, somebody 0.6. 0.4 and 0.6. 0.4 and 0.6 like that. Ladies and gentlemen, with this, now I should be able to get the covariance very easily. Very easily. So the first figure, which by the way, I ought to have written here, but for lack of space, I would want to transfer this here. For lack of space, I would want to transfer the figure there. I'll come and pick my calculator. Pick it nicely. I have here my brackets. So open brackets, my friends. So we have 15 minus 16.8. 16.8 close brackets there. Say times, because in between here we have times. Open another bracket, ladies and gentlemen. We have 12. 12 minus 16.8. you close times 0.4, which at the end of the day will give me 3.456. So this will give me 3.456. 3.456. Come and pick the second one there. The second one, what do we have, ladies and gentlemen? We have open brackets. So open brackets here, we have 18 minus 16.8. Close brackets times. Open another bracket, ladies and gentlemen, here we have 20. 20 minus 16.8. 20 minus 16.8 close times 0.6 probability equals, I'm able to get 2.304. So out of this, ladies and gentlemen, please come and combine them. Once you combine them, so plus, we have 3.456 equals, which gives me 5.76. This 5.76 is what we call the covariance between those two parameters. The covariance between those two parameters. Now, the first thing, whenever these examiners tell you to ascertain the standard deviation, which is a measure of risk, the standard deviation of the portfolio, the first thing that you need to do is to give us that covariance, that association between these two securities. And once you have that association between those two securities, ladies and gentlemen, then getting the standard deviation will be a walk in the park. So this will be a walk in the park. What do I mean, ladies and gentlemen? To come and get standard deviation of the portfolio, ladies and gentlemen, this is how I will do it. Remember, it is standard deviation of a portfolio which is a combination of assets. So what I'll do is to combine the risk factors. So we'll talk of weight of X, standard deviation of X, plus weight of Y, standard deviation of Y. But remember that these things must be in terms of variances, because mathematically, it's not possible for us, ladies and gentlemen, to be able to do, it's not possible for us to add standard deviations directly. So you square everything there. And then we'll come and talk over plus twice the covariance between X and Y. Twice covariance between X and Y, and then you attach the weights. Don't forget to attach the weights as you crown up everything with a big what here? Square root. With a big square root. Ladies and gentlemen, remember we had the weights. Aura had both 30% of X, 70% of Y. So we have here weight of X is 0.3 times standard deviation of X, which fortunately I saved there 1.47 plus 0.7 times 3.92. These ones must be done what here must be squared plus twice the covariance that I have here, which is 5.76 times the weights. Like, and then at the end of the day, we have to crown like that with a big square root. Standard deviation of a portfolio is the one that has a big square root, but you need really to understand this and understand this very well. So from there, what do we do? Our calculator now at work. We have 0.3 squared times 1.47 squared, 1.47 squared. Great. Plus 0.7. 0.7 squared times 3.92. 3.92 squared. 3.92 squared plus 2 times 5.76. 2 times 5.76 times 0.3. This calculator of mine is quite limited. I think we just have to go back and work on this step by step. Work on it step by step, because I can see it's a limited calculator. So because it's a limited calculator, first of all, I'll talk of 0.3 squared. 0.3 squared times 1.47 squared plus 0.7 squared times 3.92 squared equals plus 2 times 5 point. Okay. That's a problem, but we shall overcome. 0.3 squared times 1.47 squared equals first plus 0.7 squared times 3.92 3.92 times 3.92 squared plus 2 times 5.76 times 0.3 times 0.7, which at the end of the day gives me 10.14. So that is what we call the variance. So the variance is 10 point. So the variance of the portfolio, is 10.14. And therefore, the standard deviation of the portfolio will be the square root of this 10.14 like that, which will end up giving us 3.18 like that. 3.18. Ladies and gentlemen, the moment I have the standard deviation, in most cases, these examiners would want you to ascertain the CV. This examiner would want you to ascertain the coefficient of what here? Variation. So how do we get the coefficient of variation? The coefficient of variation is also a measure of risk. To get coefficient of variation, ladies and gentlemen, coefficient of variation CV, we normally talk over S over X bar times 100. We normally take the standard deviation over X bar times 100. This formula can be rewritten as follows. CV will be equal to standard deviation, which is like that, of the portfolio. All over X bar is the expected return of the portfolio times 100. So the standard deviation of the portfolio that we have here is 3.18 divided by expected return of this portfolio, if you remember, which was 16.8 times 100. Times 100. So with that, ladies and gentlemen, we have this divided by 16.8 times 100. That gives us approximately 19%. Approximately, this will give us 19%. Approximately, this will give us 19%. This will give us 19% approximately. So, ladies and gentlemen, and that is it. I wanted really to lay a strong foundation for us in CIFA, because we want to teach this CIFA program like in a way it has never been taught before. We want RCM, the way we normally offer unparalleled CPA classes, we want also our CIFA classes here to be unparalleled. So, ladies and gentlemen, I would just want to leave you with some homework here, which will be the next question that we shall be tackling after. The next question that we shall be tackling in our next class, ladies and gentlemen, I would want you to appreciate it in advance. Yeah. So this question I would want you to appreciate in advance. It is, ladies and gentlemen, this is May 2018, question number 4A. May 2018, question number 4A. May 2018, question number 4A is the homework that I will leave you with. 2018, question number 4A, especially on this concept of funding ratio and then how to calculate risks and expected returns of a pension plan. Otherwise, thank you very much. Please, as you are doing this particular course, don't forget that CIFA has to be underpinned by stronger financial analysis skills through Excel. You need to know the pivot tables, you need to know the index match, those concepts of Excel, how to analyze big information, big data using advanced Excel techniques. Advanced Excel techniques, we normally offer them at RCM. They normally go for 4,000. It's a 1-month program of advanced Excel that I teach personally. 4,000 Kenya shillings, 4,000 Kenya. If you are interested with this particular program, please give us a shout, give us a call. This is our number. Otherwise, thank you and thank you very much. God bless you.